Imagine this, you are going on a road trip with your friends, but being a college student, you are on a strict budget and you cannot spend more than $500 collectively. The budget includes all the expenses that you might have, including transportation, food, living expenses, etc. You use all your past road trips and you calculate the amount of money you used to overspend on the previous trips. Based on that, you get your value at risk, which tells you, let's say you did all the calculations and stuff, and you get the number $50. So there's a 95% chance that your trip will cost $500 or less, but there's a 5% chance it will cost more than $550. I just explained to you what value at risk is with a simple analogy, and one of the ways people actually use this in the financial field, that is money management. Moving on to the definition of value at risk. So value at risk is the potential loss in value of a portfolio or asset in a specified time period and confidence interval. In the previous example, I did not use time period because I did not want it to be confusing. This is most commonly used in banks, investment firms, and corporations to manage the potential loss in their investments. One of the things that people get confused in this topic is that they say it's the minimum or maximum amount of money you can lose, but it's not really an extreme, but it's a threshold value that people look at to manage their risk. For example, if a portfolio has a 1-day 95% VAR of $1 million, it means that there is a 95% chance that the portfolio will not lose more than $1 million in 1 day. 95% chance is not 100%, which means that there is a 5% chance. It is small, but it's there, that your portfolio will lose more than $1 million in a given day. If you think about this, it means that once in every 20 days, you are bound to lose more than $1 million. But in the real world, that's not usually the case, and the bad days are usually clustered together. How is value at risk useful? Well, it's used in basic risk management, and it gives you a clear picture of the financial risks involved so you can make informed decisions. It also helps you prepare for potential overspending, also helps you in capital allocation and managing your assets. What are the different ways you can calculate value at risk? There are 3 methods: parametric, historical, and Monte Carlo. Let's go over all 3 of them one by one. So the parametric method. The basic assumption of this method is that the returns of a portfolio are normally distributed. It's quite popular and it's quite easy to understand. This is one of the methods that is more skewed towards mathematics. The only variables that you need for this calculation are the mean and the standard deviation of the portfolio. Let's go over a simple example. I've given you the formula that people use, but this is incomplete. This also requires the square root of the time period that you're calculating the value at risk on. But again, I want to keep it as simple as possible and not dive too much into the detail. So I'm just going to give you the formula and assume we are calculating on a 1-day time interval period. 1 day means that the square root of 1 is 1 and you're just multiplying this equation by 1. So it doesn't matter if you put it there or not. We take the standard deviation in dollar terms of $50,000. The mean is $35,000 and the z-score for 95% confidence is 1.65. The z-score is, we get the z-score using the z-score table. If you don't know what z-score is, just know that it's an instrument that people use to calculate volatility. So if you put all these three variables into the formula mu minus STD times z-score, we get minus $47,500. This means that on any given day, there's a 95% chance you won't lose $47,500, but there's a small chance that you just might. The historical method. This is probably the easiest method out of all three. Usually people use this if they cannot determine the distribution of the returns. And the core assumption is that the past always repeats itself. The way you do this is gather all the historical data, sort it in ascending order, and based on your confidence interval, get the value at risk. So if you have 100 observations, if you want to calculate the VAR at 95% confidence, then you go to the fifth element, and that is your VAR. And you will know that 95% of the time, you will not do worse than this amount. If your data set is more than 100, then you just use a percentage value of 5%. The Monte Carlo simulation builds on top of historical VAR. If you don't know what Monte Carlo simulation is, do check out my other video where I go into it in depth and also give you a coding example of how you can use Monte Carlo to predict stock prices. But to give you a brief overview, Monte Carlo simulation takes up historical data, then uses a specified standard distribution and random numbers to predict the value of what the stock or portfolio might be. Again, this is on a specified time period, which is very important to note. If you do this only one time, of course, it's not useful at all because it is random. But after you do this about, I guess, 10,000 times or even 1,000,000 times, then you start to get a better picture of what the value might be. In our case right now, if we have 10,000 outcomes and want to calculate the VAR at 95%, then we take the observations, sort them, and then take the worst 5%. The same as the historical method, but in this, you're actually predicting what the future might be. This is one of the more complicated but also more reliable ways to calculate VAR. If you enjoyed this video, do leave a like. And if you want to join my quant journey, where I plan on building my own algorithmic trading firm as an undergrad student, definitely subscribe and leave a comment down below on what video you want to see next.